Sasha, you can, talk about the spike in yield, drop in earnings from Alphabet. Bottom line here is that global markets are in a zone of stickiness, and there is a risk of movement. And the spike in global volatility, CBOE VIX, post what's happened on the geopolitical front, it is a clear indication that markets are bracing themselves for volatility, maybe some more downside, and the commitment levels actually have fallen down. Now, I don't think the geopolitical situation is the real reason why markets, in a sense, global markets have become sticky. I think it's profit booking, maybe valuations, and the construct of what Fed could do in their coming meeting in first week of November. So everything has come together, and I think and global markets have just hit what could be called as a pause button, or they've hit a air pocket where in the near term you can easily make a case that nobody wants to commit to large capital, given that there are so many permutation combinations which are at play. Valuations are not that cheap, so fresh money is unlikely to chase the fall. Macro cross corrections are changing, whether it is crude, currency, or what is happening to the volatility index. And on top of that, you've got wild moves which are there in the commodity market, courtesy China and courtesy geopolitical tension, which in a sense are making the landscape slightly more difficult to predict. So we are going through a patch of unwinding. Typically this happens when couple of factors come together, and I think for the first time the bullish template for global markets in the year 2023 has got challenged, and my personal view is that this state of affair actually may just linger along for some more time. So it's not like, you're going to see a big fall, but you are unlikely to see a big rise, even though everybody has welcomed the fall.
Okay, so perhaps we'll languish around these levels, or this kind of a mood is going to continue when it comes to the broader markets. And let's take out some interesting data, talk about the kind of fall that we've witnessed over the last 5 trading sessions. What's happened for the frontline index? We've shaved off 3.5%. It's been the lowest level since June 30th, below the 50 and the 100 daily moving average. For the mid-cap index as well, lowest since August 25. You've got the mid-cap index, which has declined about 5.3%. Yes, the carnage has been worse when it comes to the broader markets as well. And when it comes to individual sectors, the last 5 days has seen the PSU banks hit the most, 6.7% being shaved off. Metals following suit, PSC, realty, those are some of the sectors that have declined close to 5% apiece. And Nikunj, given that you're talking about the global sentiment continuing to remain sort of the way it is, what does that spell for our own markets, especially the broader markets?
So, we've been talking about this narrative that foreign institutional investors are buying, domestic investors are only, so foreign institutions selling, domestic institutional investors are buying, retail is active, and HNI investors they continued the commitment. But in last 2 or 3 days, I guess the reverse has happened. The selling in the broader market is quite excruciating. And when you suddenly see a fall of 5% in the mid-cap index in 5 days, a 5% sell-off in the small-cap index in 5 days, it just... it does not puzzle you, but it just tells you that how the trade in the broader market seems to be reversing. Now, if I talk about the broader market per se, I don't think the broader market is looking attractive yet, where you want to chance your arm or you want to go against the trend. So you do not want to catch a falling knife in the broader market. Mid-cap stocks, selectively, I think they will start looking attractive. Now, whether the turning point is today or next week, I'm not so sure, but a turning point in select mid-cap stocks, I think, is around the corner, because the selling is quite excruciating, and a lot of mid-cap stocks, good mid-cap stocks, have become attractive. Large-cap stocks, I think you should start buying them, especially financials and large private banks, because they offer margin of safety. So I'm not surprised at all with what is happening. See, the small-cap bull had become obese, and now they are on the treadmill. They're losing some fat. Now, if you are obese and if you've gained a lot of weight and if you want to lose fat, you cannot do it overnight. It would be a process. And I think that is what is at play right now, where the small cap bull has realized that it had become too heavy. Health warnings were coming from everybody, and they have to lose fat and they have to become fit and fine. But just like you gained fat in a matter of 1.5 years, you cannot lose fat in just 2 or 3 days. So I think it's the same process which would be at play. Just imagine the small cap bull had become big and unhealthy. He'll gone on intermittent fasting and on the treadmill. It will be some process before which you will lose that fat and become healthy again.
Yeah, it's going to take a lot of hard work to get there.
See, as long as the attempt is there,
Yeah.
intention, and which I think the correction
And
has already set in.
dedication.
So correction
Yeah.
has already told you that mid-cap bull, you lose weight. Otherwise, you'll blast.
Yeah. I mean, but we're not alone in this weakness. If you were to just look at how the global markets have panned out over the 5 days, it's pretty much the same state across the globe. Look at even, periphery markets like Philippines, they're down 4%. Korea is down nearly 4%. China has lost 3.8%. We, of course, have fallen a tad less than 3.5% on an index basis. Japanese Nikkei is down about 2.5%. Indonesia is down 2.5%. Thailand, Taiwan as well as Thailand, these are all markets which have seen quite a bit of correction in dollar terms. In the meantime, of course, it's a different thing as to, when you look at individual sectors, Nikunj. And I was just looking at over a 5-day period, the Nifty PSU Bank Index is down nearly 7%. Metals have cracked 6%. Some of the best performing sectors year to date, like realty also, have cracked about over 5%.
So let's say if you are holding any stock, and I'm going to just start by very basics, what you've learned, what I've learned over the years. You got to ask yourself is that why is that stock part of your portfolio? If you bought a stock just because you've got a tip in a lift, then maybe it's not the best time to own that stock. If you bought that stock with the assumption that, okay, this is a sector I want to be in, I can digest a 15-20% volatility, maybe a 30% downside, which may not be permanent in nature and it's not going to change my conviction, my commitment levels, then you should hold on to it. This is not a market where you should buy the first fall, because typically the first fall is always followed by compulsive unwinding. For me, the market bottom in the mid and the small cap stocks will happen when there is panic, when there is compulsive unwinding, and when I see a serious drop in terms of the technical patterns. I don't think we're there yet. Large gains in small and mid cap stocks are made when you are buying, and when you're buying when there is reasonable amount of value or reasonable amount of macro tailwind, or there is a big sector which, in a sense, when new sectors are getting created. So you want to ask yourself first your risk appetite, your time horizon, and the reason why owning a stock. So this is very basic, Aisha, which is what I've learned over the years, that if you adopt this, I think this fall 6 months from now, a year from now, will actually look like a buying opportunity. But then you got to be clear that why are you buying? If you're buying pretty much with the assumption that you'll buy today and sell tomorrow, I think that buy today, sell tomorrow, buy on Friday, sell on Monday, that trade in the near term is getting challenged. So don't be in that trap. You got to understand that equity markets are fraudulent with risk, and that is something what last couple of days have once again reminded us. Hard facts, but hard fact is a hard fact.
Yeah, and today's going to be its own challenge. We've got expiry as well.
It's one of those, patches where you would say the expiry is not going to be, the commitment levels are down, let me put it this way. Now, if I look at what the Nifty poll is indicating, sliver of the market men suddenly are talking about expiry above 19,400. Whereas the consensus seems to be that the Nifty will settle in and around 19,000 to 19,200. And that really may be the case. I mean, because there's FNO expiry and the next series is a long series and Nifty futures are not trading at a premium, you may just close between 19,000 to 19,200, which frankly may not be such a bad outcome for the Nifty. I think banks, again, I've been talking about it. I would stick my neck out and say that banks is where margin of safety and the earning visibility in the near term is there. I guess in terms of themes and sectors, there is a festival season trade which is at play, whether it is travel, whether it is hotels, whether it is food, or whether it is anything to do with binge consumption. I think that is the second theme you want to be in. You want to be a buyer in manufacturing and alternate energy, but on every decline. I don't think it's time to still buy into IT. I don't think it is still time to buy into FMCG. And I think pharma companies selectively could be the other big sector. So if you have to really talk about what you should be doing in this market, look at banks, select pharma. There's a trade in some of the consumer names because of festival season. Avoid IT, manufacturing and energy stocks, buy them on a decline. But in general, you got to just ask yourself why, how, and time frame, then only trade.